Thank you, Sam. All right, first of all, let me say that Perpetual being an active shareholder is not a new idea, and we've been doing this for a long time under various heads of equities at Perpetual, but we are still learning. Today I just want to talk in a practical sense about what is an active shareholder and why do we do that, and our approach to being active and engaging with corporates and promoting change. So our definition of being an active shareholder is to use all the tools at our disposal to maximise shareholder value for our clients and for your members. We use voting and engagement with boards to get effective responses from companies. There's a lot of talk in the media in recent times about activist investors, and I just want to be clear that we are not that. They're often focused on an event or a shorter-term angle with a company, but we're on the other hand a long-term active shareholder, and we try and maximise value as long-term owners of a business. So the types of things that we tend to engage with companies on include governance and longer-term ESG issues, and they might include our views on mergers and acquisitions that boards want to undertake, remuneration issues like where we tackled DJs and Horizon, environmental issues like with Orica, paying out of franking credits, and I can't remember how many companies we've tackled that issue with, but it's a lot, social and supply chain issues with the various retailers. But it isn't easy. There's a lot of roadblocks to being an active shareholder, which sometimes prevents us from achieving the aims that we wanted when we're asking companies to change things. Boards can often give the excuse that they have to do the best thing by all shareholders or all stakeholders, which sometimes actually means that they do nothing for any shareholder. There's a risk of litigation, and we're seeing that ourselves with Brickworks and Sols and the action that we're trying to take there. There's a reputational risk of becoming too activist when you're on the register of a company. Boards sometimes claim that there aren't enough resources to carry out the required actions, and there's a need for critical mass. So you can't necessarily achieve anything if you're a lone voice, but that hasn't stopped us from trying. So what's our framework? How do we approach all of this? The framework that we follow in being an active shareholder is pretty simple. In order to maintain focus, we centre all of our discussions and strategy in approaching companies around this subject on getting a better deal for shareholders, and only where our clients or your members have a financial interest. So we don't attempt to change the entire listed company landscape, and there are always some companies that we won't invest in because management doesn't meet the grade or governance practices aren't right with respect to our own quality filters. We do initially invest with an eye for good corporate governance, and we want to see companies being well managed and boards looking out for the interests of shareholders before we actually make an investment. And we do exclude companies where we feel the culture isn't right, because it's very hard, if not impossible, to change things where poor practices are already ingrained. And I think that's just recognising the limitations of our engagement. And from a performance point of view, it's fair to say if we don't trust the people involved, then there's no upside from getting the structures right. And I'll just give you a quick example of that. So this company, MFS, used to be listed at the 2007 stock market peak. It had a good board on paper, so a 7-member board, 5 of whom were independent, non-executive directors. It had a code of conduct, and you can see there that included the words utmost integrity and objectivity. The company failed the following year under $500 million of debt, and management ended up in court over questionable practices. And that just shows that for a company like that, we never invested and we never would have. So we're not trying to change all companies, we're just trying to enhance the good ones. So from that point of view, we don't start with an adversarial relationship with the companies we invest in. We don't start with a fight, but we find that creating a reputation for engagements helps in achieving outcomes when we do want to change things. At the end of the day, the companies that we invest in generally do want our support, and they tend to deliver performance and have good disclosure and tackle the ESG issues adequately, so they continue to receive it because, and this is a really powerful concept, the capital market support creates the freedom for companies to execute their preferred strategies. So we try and have an open and honest culture when dealing with companies, and we provide positive feedback where that's warranted, but we also hold them accountable for their structure and corporate governance when we need to. And it really helps that we've had a long history of doing so, because people expect us to do that, and they're generally, because of that, more receptive to suggestions. And that's because they know that we're trying to look out for the interests of all shareholders, and companies are generally on board with that. So creating that expectation that you'll always engage with companies helps us get the required audience. We get to have the audience with people where we can have the tough conversations. And in response to that, we've actually seen companies come back to us before AGMs and say, well, how are you going to vote this year? They really want to know that, so they're not embarrassed at the time if we're voting no. They want to understand. They know they can get a response from us, what we're going to vote and why. And they find that our advice can actually help other shareholders as well. So just looking at the various elements of our approach, the first one being we have a longer term focus as owners of a business. Secondly, we pre-qualify all of our investments based on our investment process of quality first, and we try and understand all the issues before making any investment. Thirdly, we have a clear approach to dealing with any issues when they come up. People expect us to do that, and that reputation helps. And we do try and raise the bar through better disclosure and standards. And lastly, all of that comes under the umbrella of improved company performance, which breeds a high level of confidence, which over time should help achieving a higher share price for our clients and for your members.
I'm going to therefore focus on the environmental and social issues around active ownership. And I'll focus on two elements. One is where trustees are very comfortable, I think, and that is where environmental, social and governance factors relate to returns, and we're addressing those are actually good for returns. But the second is really around the changing expectations of investors by regulators, members and social interest groups or NGOs, and where there may actually now be a misalignment between what those expectations are and what investors believe their role is. Both of these aspects require a response, an active ownership response. Now, recently on the first issue about ESG and returns, recently the New Zealand Superannuation Fund reviewed our investment beliefs in this area. We have a set of investment beliefs, and they're a very critical part of setting our investment strategies. And to review the investment beliefs in this area, we reviewed the empirical evidence out there and some of the more recent academic work done. And of particular note would be the Deutsche Bank meta-analysis, which reviewed over 100 studies. Anyway, the outcome of this for us was to really increase our confidence that good ESG performance in companies improves returns, it reduces risk. And just to quote one part of that study, 100% of the studies showed a positive correlation between good ESG performance and low cost of debt and low cost of equity. And 90% showed a positive correlation between stronger market or corporate financial performance. So we've definitely strengthened our beliefs in this area, and that actually helps with the active ownership program as well. So that ESG adds value, integrating it actually applies across passive and active portfolios. Of course, with passive portfolios, you're pretty much invested in everything, so you're not really selecting better players. But we believe that active ownership can improve the quality of your passive portfolio as well. The whole idea of all boats rise in a rising tide, or I prefer also that boats that don't hit the rocks are less likely to happen on your portfolio if you take account of these issues. Now, the other area is really about what is the changing expectations and views of investors out there. And as a sovereign wealth fund, we certainly get more than our share of attention from NGOs and active groups. And recently we had protesters in our office chaining themselves to our reception desk, and a lot of social media out there on all sorts of issues, actually. But I see this changing expectation amongst regulators, amongst your members. I think investment managers are seeing changing expectations of what they're expected to do from their clients, and also from NGOs. So one of the sort of instances amongst the regulators is the advent of the UK Stewardship Code, and within that is very clear reference to engaging with companies, and that's across the environment, social and governance area. Also in Australia, you're facing increasing calls for more transparency across your portfolios, and that's transparency into your private market portfolios as well, where you have arguably more influence on these issues. And I think that if you aren't aware of it, I think another very interesting aspect on the regulatory front was the issues around the OECD principles. So last year, both the Norwegian Superannuation Fund and the big Dutch fund, APG, were referred to their national contact points. National contact point for the OECD principles within their countries. Now, the OECD principles have generally been seen to apply to companies. In this case, it was the shareholder in the company that was the reason for the fund being referred. Now, what came out of that was that active engagement in using your influence is appropriate response as a institution if we're actually caught by these requirements. Interestingly, if you look at the response by the national contact point in Norway, if you're in private markets, then that influence is seen to be even larger, and therefore your responsibility even greater, which goes to the point that active ownership is also about private market investments. Amongst clients, I think one of the really interesting surveys or polls was done by the Responsible Investment Association last year, which actually showed that over 60% of people, that was a poll of 1,000 Australians, over 60% preferred a responsible investment fund for their super. 69% believed that it was important for their super fund to take account of environmental and social issues, and over 80% thought that it would not negatively impact but would positively impact returns. So there's certainly a demand out there amongst clients. However, I think perhaps it's not necessarily that the clients will invest in an ethical option. Obviously, they should more likely be to do so, but just that they expect their super fund to implement responsible investment policies. So now just to focus a bit on the whole explosion of social media and expectations from social interest groups, and what do they really want of investors? What is their perspective? And from my experience, often there is no distinction in the way they speak to investors. There's no distinction between shareholders, boards and management of companies, potentially in the minds of those that are campaigning on companies on our portfolios. There's also a tendency to think that perhaps we have more influence than what we have as shareholders, because we are minority shareholders, often with a very small m. It can just be an outlet for anger against the company and social media you will see that. Or they also believe that the investment that you have has actually gone directly to the company rather than just being a trade in shares, and therefore divestment will have an impact if enough investors divest. Now, this perspective might you might be able to challenge that, but nevertheless, if a company is facing a significant media and social media or campaign against it, then it is bad for business. So therefore, how should one put in place a good active engagement program which encompasses not just the governance aspect, where there's some very well developed codes and policies and collective action, but also covers the environmental and social issues, which across 6,000 companies which we hold can be very sort of immense number of issues that come up. Well, firstly, if you use managers, you can include these requirements in RFIs or RFPs, we do. You can include active engagement in mandates, and we do, and also in reporting. There's an increasing number of suppliers that also can assist with active engagement and research. So any program, first of all, you need to know the portfolio. And now we have research agencies that can monitor and identify the most material issues that you have on your portfolio. It's a little bit, you know, in the early days this was something that investors had to do in-house, but now you can buy that research in. You need to prioritise. Now you might want to pick up your manager's priorities or internally develop some priorities. We look at the most material issues and breaches of international standards that we expect companies to uphold. You may also want to look at which are the companies that are very poorly rated on the biggest ESG risks in their area. You will also want to consider the degree of influence you have. So in your own backyard, particularly collectively, you'll have a lot more influence with Australian companies. But then, nevertheless, a lot of the material issues may be companies from offshore. And then you need to think, how is this to be resourced? Is this in-house, outsourced? Is it a mix of both? Collaboration with others through different forums that you belong to. UNPRI, for example, has a very specific program around collaboration on active ownership on environmental and social issues. What you do need to do, and we've had a review of our engagement process recently, because we found that there's quite a lot of resource required in maintaining the momentum. It can be a number of years before you can for you to actually see outcomes with companies. But then again, we're long-term investors and we're going to be in these companies for decades. You need to understand what the issue is to the extent of having some sort of solution to that issue. And that's actually where some of the social interest groups can be very useful, because they often will know what is the best way to approach quite complex problems. And it requires persistence and also measuring change. Now, if you have managers that do that for you, then you can have that as a reporting function to your board or to your CIO, 6-monthly basis to see progress. And then I just sort of finally conclude by saying this is really part and parcel of your private markets as well. And when you are transparent, and I think transparency is good, members need to see what companies they're invested in, but certainly that will extend the active engagement with companies to companies on your private market portfolios. And the good thing about that is actually you can have more influence.